Welcome back to the Schaeffer's Market Mashup. It's been a while, everybody, and it's good to be back. I took a week off during election week, even though, let's be honest, that felt like a month ago. But hey, we're here, we're happy, we're healthy, and I'm excited for today's interview. Please welcome Bill Looney, Managing Director at Exchange Financial Access. Bill, thanks for coming on.
Hi, Patrick. Good afternoon to you, and thanks for having me. It's a pleasure to be with you.
Awesome. I guess I'll just start with a little bit of intro with what we're going to be talking about today. Options volumes have not slowed down in 2020, despite the rest of life essentially slowing down. Average daily volume this year is up more than 40% from 2019, and the options industry is on track to hit a record of more than 7 billion contracts in total volume by the end of 2020. 9 of the top 10 most active trading days have occurred in 2020 alone. So, Bill, I want you to, you're coming from, this is the broker-dealer's perspective. I want you to first talk me through your career and how you've got to where you are at XFA, and then give me a little breakdown of what XFA offers.
Sure. Yeah, well, I've been in the business just over 2 decades now, and for the biggest piece of my career, I was on the sales and trading side. Started out in the fixed income world, eventually migrated to the equity derivatives world, where I did institutional sales and trading for a number of years with a lot of the big banks. Subsequently thereafter, I headed over to SIBO for a 7-year stint and wound up my last role at SIBO was running the index options business there, specific to SPX and VIX, products like that. And about a year and a half ago, I joined XFA, heading up their global business development efforts, basically parlaying my sales and trading as well as exchange background into helping to grow and continue to advance, obviously, the global customer base that XFA services. So it's been a wonderful opportunity. And we've had some big news at XFA last week. We were acquired by Marek Spectron, and they're a global commodity specialist headquartered out of London. And we're very excited about the opportunities that our partnership with Marek Spectron is going to afford us, because they have a number of complementary product areas, and they're going to obviously allow us to grow our international footprint and offer more products and services, with a larger balance sheet offering and potential clearing. So XFA is in great shape, very exciting times for us. And I do believe you kind of wanted me to segue into XFA a little bit in terms of, Exchange Financial Access, but pretty much the street knows us as XFA, our 3-letter acronym. We are an agency broker-dealer. We specialize in the execution of equity derivatives as well as future options products. We maintain operations in SIBO, at the CME, as well as a number of other exchanges, and been around since roughly 2001, formulation of a few very long-term traders in the space. Had a lot of foresight back in the day when the banks were pulling off the doors to trade a broker-dealer that was more based and covered the institutional equity derivatives and futures options community. Wow.
Well, first things, I guess I should offer up a congratulations, right, on the merge. And for one, I'm excited because most of my interviews have come from from the analyst side. You're my first broker, so I have a lot of, I'm going to really be picking your brain here about that side of the aisle. And I guess, let's just jump right in. What does it mean to be, a floor-based agency broker? And what specific services does this come with for customers within the larger trading ecosystem?
Sure. Well, what it means to be an agency floor broker, the agency floor broker is basically this. The key word in that is agency. In other words, we don't commit capital. We sit as an agent in between two principal sides that take risk, a buyer and a seller in this case. And we help them strategize on the best way to execute that order, and predominantly we provide them with market transparency and access to the entire liquidity ecosystem that's available for the given product that they're trading. So Broker-dealers, there's many of them. There's inter-dealer brokers. Banks are considered broker-dealers. But an agency broker-dealer is an entity that does not commit capital but services its customers from the standpoint of helping them to execute their strategy the best way, the most strategic way, transparently, with a lot of anonymity, covering the buyers, sellers' identities, obviously, and then supplying the marketplace with information as well as access to the liquidity ecosystem and speed and efficiency. And the services, we provide are obviously execution based, as I've alluded, but we are floor based in the sense one of the key attributes that makes XFA very unique is that we are floor based, meaning most of the staff that work for XFA are located on the actual trading floors. The two biggest trading pits that come to mind, most of your audience would be aware of, would be the SPX, the VIX options pit at the CBOE. We also maintain floor operations over at the CME, Eurodollars area, as well as in the S&P big contract area. But being on the floor really gives us a tremendous ability to access the largest liquidity available to the marketplace, especially in the bigger index products, the larger notional products. And we also have an incredible ability within these larger index-based products to offer speed and efficiency with execution as a result of being positioned there. So it's a very unique setup in the broker-dealer community, and it's definitely one of the attributes that makes XFA stand out.
I agree. And it's ironic that, entering January of 2020, would you have foreseen all these changes that, were coming to, being a floor-based agency broker? Nobody saw this coming. So, in the fact that you guys have had to adapt and adjust makes, kind of your function all the more fascinating, I think. So, to build on that, what types of execution avenues do you have available for trading? Walk me through what happens and what the process is.
Sure. Well, you're exactly right. Nobody foresaw COVID coming. I mean, for a very long time, as electronic markets have developed, especially within the derivative space, and liquidity on screen has developed to be meaningful enough where a large array of customer types can interact with it. There has always been talk of, are the trading floors going to close? Are the trading floors, going to close, or are they going to go away? And the simple fact of the matter is they haven't yet. All options can trade on a floor to this day, whether they be single stock, whether they be ETF options, index options. But the index products in particular are where the floor really stands out in its ability to offer speed and efficiency. I mean, you have to take into account, as an example, the SPX being up near 3,600 or so. One contract notionally is $360,000. When you have these larger institutional players that are trading multi-leg strategy, buying and selling multiple strikes at a given time, sometimes to the tune of up to 8 legs, multiple thousands of contracts, it really helps to have humans involved. That doesn't mean that the electronic marketplace doesn't serve its purpose and doesn't have an ability to serve clients' needs. We at XFA use electronic execution for our own customers when we deem it appropriate, when we deem it necessary. Mm-hmm. But to the one part of your question, what types of execution avenues are available? There's basically 3. If you kind of want to make the statement like an umbrella statement, what can you do? On the one, I don't want to call it extreme, but on the one side of the equation, you have electronic execution, which is basically where the end user customer takes the responsibility on entering the order through a front-end execution management system. Okay. That system communicates, to your point, when that individual presses the button on the mouse that says buy or sell, that system communicates with what's called a back-end smart router. And that smart router is designed to execute that order in a smart way because there are literally 16 option exchanges that exist, with more on the horizon. All of these exchanges have different fee schedules, different setups. They take price, time, pro rata. This is very nuanced stuff, but different ways that they engage the marketplace, different cost structures. And these smart routers know how to execute those orders in the most cost-efficient way while achieving best execution. But with that said, the customer ultimately responsible for handling the order, and the customer is going to interact with the market-making community on the other side that is resting on the bids and offers that they're engaging with. So to some extent, you get a little bit of a limited interaction. Again, not to say that it's not a good thing, but you have to understand the dynamics of what that particular execution type has and can offer. If you go to the other side of the equation, the complete other side of the equation, you go over to, let's say, the big bank desks, the investment banks that can make capital for customer order flow. So this is typically for the larger institutional type orders, where a customer may want to buy 5,000 or 10,000 contracts of a particular name, equivalent to 500 or a million shares of stock, 500,000 or a million shares of stock. The bank will actually take the other side of that transaction and guarantee a price. And then they themselves will go down to the trading floors or execute electronically through the processing mechanisms that are available and say, hey, we have a buyer and a seller here, and then the market participants. And then in the middle, which I'd say is the largest playground, is the agency side of the equation, which is where XFA thrives. Our customers, our global customers, are very astute because they understand the value of electronic trading. They understand the value of capital commitment trading. But in the middle, they really understand the value of agency trading, which gives them an ability to come to a professional broker-dealer like ourselves that understands the liquidity. There is a lot of providers of liquidity in the derivatives marketplace, not just market makers. There's upstairs proprietary trading units. There's bank desks, dealer desks. And XFA, as well as broker-dealers like us, have an ability to access those markets on an agency basis, find out where the best pool of liquidity lives or where the best price lives, and then we can combination execute some part of the order electronically, execute some part of the order in a block transaction type facility mechanism, and get the customer done at the best price with a commission level that's in between those two extremes. And nowadays, especially for the institutional community, transaction cost analysis is a big part of the management of their business because making returns is obviously not easy. So we really afford customers best-in-class execution because we take advantage of all possible ways of executing orders, and it's what we do. We know it best. We do it the best, and we have a big presence doing it. So it's a very complex ecosystem of not only execution capability but of liquidity. And customers out there have to understand it and take time to learn it. And that's really, our value at XFA is to get in there and help those customers execute those orders the best way possible.
Yeah, what I feel you just explained is almost like showing someone like how the sausage is made. And I think it's important that people know what exactly is going on, how much is being weighed, how much is being calculated, to know where this out, the flows are coming from. So,
well, if I can add a point, you mentioned the retail audience. Obviously, some of your audience is from that. The retail audience, especially like Charles Schwab's, Ameritrade, Fidelity, those platforms execute electronically, and they route a lot of their orders to what's called the consolidators. In other words, the market makers that internalize some of that order flow to the extent they want to buy and sell. In other words, take the other side of those trades. The retail orders are obviously typically smaller, so they do. There is justification to say, hey, executing electronically is the proper way to do this. There still, we do execute on behalf of some retail entities because it is still deemed appropriate to put a human in there, especially within the index option space, because we can afford better pricing. But yes, it is a very complex universe where those orders are going to a consolidator that's looking at them, internalizing them, buying and selling what they want to interact with, and then sending out through the smart routers to the rest of the system where they're going. And there is a lot of nuance.
Right. I want to circle back to the floor-based broker-dealers in the open outcry. So what exactly is occurring when you're participating in such a thing?
Well, open outcry is almost exactly what it means. In other words, a trading pit is typically a large circle or almost like a pentagon kind of setup, bleachers where people stand, market makers, broker dealers stand and holler at one another for large part throughout the day. And, again, applying this part of the conversation to the index products, think SPX, think VIX, things like that. When a bank desk, let's say an institutional customer calls a bank desk to get a market in the S&P, they're going to call a floor broker like XFA. Mm-hmm. And XFA is going to holler out to that bid whatever wants to be done. March 3,600 puts in the SPX, 1,000 up. Where are they? And it might respond with market, 3 at 5, $3 bid at 5.
You can yell a little louder if you want.
Yeah, I used to, trust me. But I'll spare the audience ears. But the long and short of it is the market will respond. Typically, those markets are a little bit wider when you look at them on the screen. If the market that you get in the crowd is 3 at 5, maybe the market on the screen is 2.5 at 6. So immediately the markets tend to tighten up, and then the broker-dealer has an ability to try to represent that order, bid for it or offer it in the middle, and try to build a picture of buyers or sellers that will take the other side and price it. And this gets back to my earlier point about the agency execution portion of the business, because we are contacting in a matter of seconds a massive array of liquidity providers. We're explaining anonymously, in other words, the customer's being represented through us, right? So yes. The customer gains anonymity in this equation where we can go in and kind of, not show our hand, but show our hand. Hey, we're interested in this strike. This is how many we have to do. Mm-hmm. Maybe we start to let them know that we're buyers, and we start to fish for sellers, and all of a sudden we come back to that customer with really good color and information on where the market's at and what the best way is to execute the order. Whether it makes sense to try to work it over a period of time because the market's coming their way, or maybe the market is not really for sale right now, so it's better to just bid for it and let it come to you.
Yep.
Or conversely, if the customer's in a rush, the market's moving, volatility's high. Think certainly back towards the COVID days when we were in the initial stages of the crisis, the volatility was shooting through the roof. You had customers that wanted to buy their hedges immediately, so get me done. Where can I? And that's where the benefit of not only the human element, but the trading bit or the open outcry element really comes in, because all of these entities are connected not only to their floor-based staff, but then to their upstairs staff, the guys that are trading proprietarily, and the communication sequence flow is seamless. It's fast, it's transparent, and it happens quickly. And I have seen, hundreds, multiple millions of dollars cross hands in the span of 5 seconds, which would otherwise take quite a bit of time with a lot more risk trying to do it electronically. So that it's not necessarily a quick definition, but I think it's a thorough definition of what open outcry trading is all about and why it applies to the larger notional index products in the market.
Yeah, I agree. Maybe because it's the NBA trade deadline, it reminds me of like how an agent is almost, will put out a couple rumors. So-and-so is interested in, or there's rumor sources say there's going to be a trade to the Hawks. And that might not be existing, but that might perk up the ears of another team who's intrigued by that. And you set the market that way.
You hit the nail on the head. Within a trading pit, there is a tremendous amount of information flow and feel. That's what our brokers are so good at. That's one of XFA's greatest attributes is our understanding and feel depth, and size, and positioning of the marketplace. I can tell you that every day I'm in touch with my floor personnel for what they're seeing, what they're hearing, what they're feeling, which way the market's leaning, which way it's skewed. And because they have access to all of the trades, not just the trades that we get, but all of the other trades we're sitting there listening to on a daily basis. So
yeah, that's amazing.
Yeah. For the market. Well, there's a great, for your audience, you can go on YouTube and you can listen to the S&P futures pit years ago during the flash crash. There's a very famous recording of one of the clerks that was broadcasting what was going on in the pit. And for your audience that wants to experience and feel what it's like to have the market move and move fast, I would highly recommend going out and listening to that, because it's a great example of just what those trading pits do, what their capabilities are. And the reality is when the stuff hits the fan, for lack of a better term, electronic markets tend to fade. You gotta remember the market makers in this community have to supply quotes on multiple listed products, 16 different venues.
Yeah.
So their quote risk management or monitoring systems are very robust, where if they all of a sudden their offers start to get lifted or their bids start to get hit, they obviously are programmed to pull back. And that's kind of what you and I are really driving at is, in a sense, what is the best way to execute my order? If my order is not going to spook the markets, it's not too sizable, it's not trading in a name that is got a pending news announcement or has a particular risk potential within itself, trading electronically oftentimes becomes a good way to engage the market. And a lot of institutional customers are embracing electronic trading from what's called a systematic standpoint.
Mm-hmm.
In other words, they use algorithms to engage the market, and they can exercise a lot of sides throughout the day. And a great example of that would be recently, I'm sure you remember hearing back in August when the market was rallying, it all of a sudden came out that SoftBank, a big institutional customer overseas, had bought hundreds of millions of dollars in notional option positions in a limited number of names. Well, they did that electronically. It wasn't because I can tell you right now, if they had gone into different bank desks and bought 20 or 30,000 options in Amazon or Facebook, Google, whatever names they're trading in, that information would have been all over the street. And it wasn't, and it kind of came as a bit of a shock. It didn't shock insiders like myself, because we know how the game is played. Mm-hmm. But there is a lot of liquidity there if you're willing to take the time to execute. But if you look at the 4,500 names, whatever the number is, of total names in the United States equities market, literally 60 to 75% of the underlying liquidity in the option space rests in about the top 6 to 10 names. It's an incredibly small universe of names where the bulk of people play. When you start to trade outside of that universe, so think financials, industrials, we've just witnessed it. And once President-elect Biden was the perceived winner of the election, we have witnessed a massive rotation. There was 5 or 6 names that contributed to most of the rally that we've seen coming out of the initial phase of the COVID crisis. Predominantly, they were tech names, stay-at-home names, Peloton, Zoom, Amazon, the usual suspects. Yep. Now we have financials, industrials, consumer staples, all of these other sectors, banks, especially getting action. Well, if you're an options trader, especially if you're trading more size, a lot of those names don't comprise those top 6 to 10 names. So you're forced to be very conscious about how you interact with the market, and you can very easily outsize the market electronically. So again, from the agency broker perspective, my perspective, our firm's perspective, this is where we make hay while the sun shines, because we know how to infiltrate that vast liquidity ecosystem and afford our customers the best execution possible.
Right. So in addition to the liquidity, and you might have touched on this before, but I do want to expand on it. What does this open outcry offer as far as price discovery?
Well, as I mentioned, when you engage that crowd, when you holler out to that crowd, they will oftentimes provide you a quote that's much tighter than the screen, because they are expressing their interest. If the crowd has been buying options all day, then they're obviously going to be better for sale. So you might come into a better offer. And you're also going to expose that order to a larger audience. Again, not every market maker is making markets on every series every second of the day. So if you're looking at a quote on the screen, you might have a quote that's being represented by 2 or 3 market makers when there's actually 18 or 20 market makers that are supplying liquidity in the marketplace.
Got it.
So that open outcry environment allows all of those potential sources of liquidity to respond.
Okay. Yeah, that I understand that a lot more now. That question was only basically for my own vanity to make sure I understood it.
It's okay. It's complex.
Yeah,
There's a lot of nuance to it.
It really is. I do want to wrap up with a big picture look. And can you offer any insight on how you were facilitating flow by helping customers position themselves before the election? And then how are you gaining your footing now after the election, looking to 2021? I've basically ended all of my podcasts, with this eye towards 2021 and the assumption that things will be smoother, but not necessarily. So I'd love to get your input on that.
Sure. Well, I kind of just touched on a piece of that answer to you in saying that most recently the market has saw for the first time much greater breadth. In other words, a reallocation to various sectors that were not really engaged in the rally as much as the 5 or 6 names, the FANG names, basically FANG Plus, Zoom and Peloton, right?
Yep.
If you want to, I'll answer your question from pre-election perspective, and then I'll answer your question a little bit post for your look into 2021. So pre-election, one of the most interesting things that I saw occur that we at XFA saw was over in the volatility space on the VIX. For your audience, who may or may not totally get VIX, VIX is a measure of forward volatility, implied 30-day forward volatility. So it's the market's attempt at anticipating the anticipation, how much movement potential and options prices is there over the next 30 days. And when it's perceived that there's a lot, the VIX will go up. Market will be more volatile. When it's perceived that there's less, it'll go down. Well, obviously volatility this year caught a major bid coming into the COVID crisis, and we actually achieved the highest level on the VIX ever. It surpassed its 2008 high during the global financial crisis. So clearly volatility went through the roof, for lack of a better term, back in March and April. And as it's come back down, or what the market oftentimes refers to as its mean reverted, VIX is notoriously for mean reverting back towards its mean fast, quickly. Mm-hmm. And it hasn't occurred. And coming into the election, which is something that's been on the minds of people for a long time this year, everybody kind of initially anticipated that volatility would go up because of all of the potential outcomes or range of potential outcomes that could occur. Contested result, you name it, who's going to win. But we actually saw customers buying puts in the VIX. And what that means is the customers were buying options that would benefit if the VIX comes down post-election. And to some extent it has, as you've probably been watching. The VIX, kind of came back down below 25, and its long-term 10-year average, which does not include 2008, is 17. And we've seen some customers taking profits on some of those positions. They range anywhere between December expiry all the way out to March of next year, because they were kind of playing for how long it's going to take for volatility to come down. But the overall assumption before the election was that volatility would come down. And so far, to some extent, it has. Mm-hmm. Hasn't moved maybe as far as it will potentially, because we have to remember we're back in a zero interest rate environment.
Yep.
And the last time we were here, the VIX was much lower, all the way back down to 10, 11, and 12. So that's one of the most interesting trade and strategies that we've seen kind of occur before election and continue. Now, post-election, obviously I've alluded to the fact that there's much more breadth to the marketplace now because people are playing for a long-term economic recovery as we come out of the crisis, as there's news now from 2 companies that they have successful trials in the vaccine, and we anticipate getting a vaccine in the next few months. There are a lot of potential factors that could create volatility if we don't have a smooth presidential transition, if there is problems with the distribution of the vaccine, or God forbid it doesn't work as well. Mm-hmm. There's a lot of potential for volatility, but customers are trading a much larger swath of names because the perception is that the economy is set to grow. Perception is that Washington will award the market a stimulus package, an infrastructure package. But I do think longer term, and I'll end on this point, there are a lot of customers that are looking further out into 2021, even out to 2022, which is a bit of ways, but they are talking about it with us because a lot of people believe that if there is massive stimulus, if there is a lot of infrastructure and people start spending money, then obviously the Fed could move interest rates higher sooner than forecast.
Yep, of course.
Because of inflation concerns, a lot of dollar concerns. So I think 2021 is setting up to have some potential bouts of volatility in it. But for the most part right now, people are not forecasting for that volatility until the second half of the year. We kind of need a lot more information to unfold and a lot more decisions to be made with regard to the incoming administration before customers can accurately start placing those bets. And it's going to be a very interesting time to trade options, and it's going to be a very interesting time to see how things play out.
Well said. Well said. If anything, that makes me feel better because I've been watching these 10-day VIX PC ratios, and we should be keeping an eye on this. I think this is a pretty good indicator, and it's fascinating to hear someone from your side basically ascertain the same thing as well as everything about 2021. So yeah, let's cut that there because I think that was as good a way to end it as possible. Bill Looney, Managing Director at XFA. Thank you so much for coming on. You have the historic title of the first broker to be on the Schaeffer's Market Mashup. I'll send you a trophy later, or maybe those little like police certificates, with the little teddy bear on it.
I'll display it proudly, Patrick. Listen, I appreciate you having me on. I look forward to hopefully doing it again, and I certainly hope you and your audience benefited from some of our contact. I enjoyed the content. I enjoyed the discussion. Thank you.
I sure did too. Have a good one. Stay safe.